All right, class, welcome. Go ahead and grab your notebooks, because today we are tackling a topic that, believe me, trips up even the pros: mastering the T4A-NR form. This is absolutely critical stuff for anyone who's going to be dealing with payments to non-residents. Let's get you ready for the real world.
And as always, the materials for today's lesson were prepared by Dr. Samir Al-Brashani with a little help from AI to get our discussion structured just right.
Okay, let's just dive right in with a question that really gets to the core of this whole thing. Are you, in your future careers, ever going to be in a spot where your company is paying someone who's not a resident for work they did right here in Canada? Yeah, the answer is almost certainly yes, and that is exactly why this form exists.
So here's our game plan for today. We're going to start with the absolute basics. What even is this form? Then we'll get into the most important part. Really the heart of it all, the withholding tax rules. From there, we'll walk through the practical side, sending the tax, filling out the slip, and filing the return. And we have to wrap up with the scary part, the penalties, so you know exactly what's at stake if you mess this up.
All right, first things first. Let's build the foundation. Before you can even think about percentages or deadlines, you've got to understand the tool itself. So, what is the T4A-NR, and when on earth do you use it?
So what is it? I want you to think of the T4A-NR as the official government record for payments you make to non-residents for their services. This could be a consultant from the US, a tech firm from Germany, you name it. The key words here, and I want you to circle them, are services and in Canada. This is not for your regular employees. That's a whole different story.
Now, I need you to pay close attention here because this is one of the most common mistakes I see, and it's so avoidable. Using the wrong form is going to cause a massive headache for your company. As you can see, the T4A-NR is for general services, performers, film crews. But if that non-resident is a regular employee or a director, you got to use a T4. And here's a weird one. For non-resident film actors, it's a completely different form, the NR4. Getting this right from the start is half the battle, I promise you.
Okay, this next part covers your single most important job as the person paying the money. Seriously, if you only remember one thing from our entire lecture today, make it this.
Here it is. The golden rule, class. You, as the payer, are required by law to hold back 15% of the gross amount you pay. Not 15% of their profit, no. 15% of the total bill. This is completely non-negotiable unless, and this is a big unless, you have an official permission slip from the CRA.
So why does the CRA make you do all this work? Well, the logic is pretty simple, actually. It is incredibly hard to chase someone for taxes after they've already packed up and gone home. So think of this 15% not as the final tax, but more like a down payment. It's a security deposit, really. It just makes sure there's some money sitting there on account for whatever tax that non-resident might owe Canada when they file their own return.
But what if that 15% is just way too high for the situation? That's where the waiver process comes in. The non-resident can apply to the CRA to have it lowered or waived completely. But look at these steps very carefully. The non-resident applies, not you. The CRA looks at it, and if they agree, they send you, the payer, an official letter. And here's the crucial part. You don't change a thing. You keep withholding that 15% until that letter is physically in your hands. No letter, no waiver. Period.
Okay, so you've done the right thing. You've withheld the 15%. Great. But your job isn't done. Now you actually have to get that money over to the government. Let's talk logistics.
In the world of tax, deadlines are everything. You have to send the tax you withheld by the 15th of the month after you paid the non-resident. Got it? So if you pay them on, say, March 20th, the CRA needs that money by April 15th. Put it in your calendar, set a reminder, don't be late.
The good news here is that the CRA makes it pretty easy to give them their money. You've got a ton of options, right from your regular online business banking to the CRA's own My Payment service. You can even set up a pre-authorized debit. Honestly, the method doesn't really matter. What matters is hitting that deadline.
All right, time to move from the theory to the practical. It's time to actually fill out one of these T4A-NR slips. We'll use a nice, simple case study to walk through the most important boxes together. So let's imagine you paid a US consulting firm, we'll call them Innovate Inc., a fee for some services. Okay, box 18, gross income, that's the full amount, the total fee before you deducted anything. Box 20 is only for reimbursed travel costs. That stuff is kept separate. Then,
Box 22, income tax deducted, that's where you put that mandatory 15% you held back. And finally, Box 27, you just need the 3-letter country code. So for the United States, that's USA. Simple, right?
Now, let's zoom in on a few of these boxes that seem to confuse people all the time. Getting these codes right is so important for the system to work. Box 11, the recipient code. For our example, Innovate Inc., that's a corporation, so you'd enter 3. Box 23 is for waivers. You only put a 1 in there if you have that official CRA letter we talked about. And finally, Box 28. You have to look up a specific industry code from the CRA's list. For a consultant, you'd probably use 54 for professional services.
We are now at the final step of the annual cycle. You've withheld the tax, you sent it in, you prepared all the individual slips. The last piece of the puzzle is to package it all together and file the official T4A-NR information return with the CRA.
And here is another huge deadline for you to remember. The entire information return, that means copies of all the slips you issued, plus a summary form, it all has to be filed with the CRA by the last day of February of the next year. This is also your deadline to actually get the slips into the hands of the people you paid.
And please take note of this rule. The days of mailing in big stacks of paper forms are pretty much over. If you're issuing more than 5 T4A-NR slips for the year, electronic filing is mandatory. For pretty much any real business, this means you are going to be filing online through the CRA's web services.
So, we've covered the how-to. Now it's time to talk about the what if. What if you get it wrong? Look, understanding the penalties isn't meant to scare you. It's about making you appreciate how seriously the government takes these obligations.
As you can see from this table, the cost of being late, well, it adds up, and it adds up fast. Filing your return late isn't a small mistake. The penalty is calculated per day based on how many slips you have. Even for a small business with just a few slips, that can hit $1,000 really quick. And for bigger companies, the exposure is obviously much, much higher.
But the biggest penalty by far is reserved for the biggest mistake. If you just failed to withhold that 15% in the first place, the CRA can hit you with a penalty of 10% of the amount you should have deducted. And believe me, that's just for the first time it happens.
And this is the crucial point. The CRA takes repeat offenses very, very seriously. If you fail to deduct the tax a second time and they decide it was done knowingly or with gross negligence, that penalty doubles to 20%. That's a clear signal from them that this whole compliance thing isn't optional.
So we'll end here with a question for you to think about. We've walked through the whole process, from identifying the payment all the way to understanding the penalties. Now I want you to apply it. In your current co-op or in your future job, what do you now see as the single biggest risk, the weakest link in how a company handles these payments? Think about it, because finding that weak link, that's where you can add real value. Class dismissed.